Okay, folks, welcome back. It's the ICT Mentorship Weekly Review and Analysis for week ending March 1st, 2019. This week, we're looking at, obviously, as we do every week, the economic calendar, the dollar index, euro dollar, cable, and the loonie. All right, so let's take a look at the economic calendar for the coming week. This is an absence of any real economic news on Monday. On Tuesday, we have PMI for GBP during the London Open. Then we have a FOMC speaker at 7:30 a.m., medium impact for the dollar index. We have non-manufacturing PMI at 10 a.m. for dollar index. And then Carney will be speaking at 10:35 a.m., which may impact GBP. On Wednesday, we have some speakers talking and the non-farm employment change at 8:15 on Wednesday. On Thursday, we have, during the New York Open, a main refinancing rate for the euro dollar at 8:30 a.m. ECB press conference, so be mindful of that. Then we have another speaker later on in the afternoon. On Friday, obviously, every month we have the non-farm payroll, Carnival ride. And then at 10 p.m. when the markets are closed, Fed Chair Powell will be speaking. So that's our economic calendar. So let's move on over to our charts. All right, we're looking at the dollar index. This is a daily chart. And what I have outlined here is the range between the old daily high here and daily low. This is the equilibrium price point of that, so we're still basically hovering around that. Given the context of this market profile being in consolidation, we're in this large range. If you would remember, I stated that we're probably going to stay in a consolidation for the dollar index. Even though this was a nice move lower and obviously a nice move higher, it's still consolidation nonetheless. So the profile for this present market for the dollar is consolidation, but I will state that we have another range in here, this low to this high, and this dashed blue line in here delineates the equilibrium price point of that. So even on the lower level, high to low range here, we're still relatively close to equilibrium. Now, what I like about it is the fact that we traded lower than the equilibrium, this level here, of this high and this low, and we had a reaction. And also between the low and the high, that being the equilibrium of this price point here, we went below it and we had a reaction. What am I saying here? I think that it is worth a shot to look for the dollar index to try to stage a rally from this level. And it becomes a critical point, in my opinion, that if it can't rally from these present lows, and if we end up breaking through that, I think that's going to be indicative of a much deeper retracement on the dollar index. Gun to my head, I don't see that personally. I still favor a run above the buy-side liquidity pool here. So these relative equal highs, I think that's still a long-term primary macro driver for draw on liquidity. We just have to wait a long, long time sometimes to get to these levels. Remember, a couple weeks ago I shared, for folks that are aware of my old videos or have access to them, I mentioned a 102, 104, 105, 107 target on the dollar index. Those were hugely linked to long-term macro analysis. So while it takes years, sometimes many years, for those targets to unfold, I still think that we're primarily looking for those same objectives long term, very, very long term. So do I suspect that we'll see a lot of resistance getting there? Probably. But for right now, I think that going into next week, I favor a strong dollar. So I'll be looking for shorts on foreign currency and dollar-based pairs that have, for instance, like we're going to be talking later on for the dollar CAD, I think that those pairs like dollar Swiss, dollar yen, could see some lift or have difficulty trading lower, and at least going into next week. Now, obviously, non-farm payroll changes all that come Wednesday, because the protocol for non-farm payroll weeks, if you don't know, this is for your notebook, Monday, Tuesday, and Wednesday are your ideal trade days. Then on Thursday and Friday, you really just don't want to be participating. You can study, you can do demo trades and such, paper trade, but you don't really want to engage on those 2 days because it's going to be highly manipulated or held in consolidation, waiting for the non-farm payroll numbers to release on Friday, 8:30 a.m. New York time. So with that said, I kind of like want to use this idea framing the likelihood that we'll see a run higher. Now, if you notice, there's really no inefficiencies in here relative to the daily chart. Now, there are swing highs in here. So our protocol is, if we're bullish, we will be targeting buy stops or buy side liquidity. If we run this high here, then all bets are off. We're going above these highs most likely, and then maybe reaching up into that weekly inefficiency, which we'll look at in a second. Going over to the chart I had from previous weeks, you can see all of the price action since those annotations have been added. What I want to draw your attention to is that we had a 96 big figure run here, ran below it here, ran below it one more time, and look at the rejection here. And then we found some support around the 96. So institutional order flow from the hourly standpoint is bullish. We've had a market structure break. Now, structure is shifted to the bullish side. Again, no real inefficiencies because this right here has been filled in. I don't see this as an inefficiency because it's part of this up move. So I don't see this as an inefficiency in the sense that price would run up here above this old high, fill it, and then sell off. Obviously, it would be a target, but we're looking at the liquidity resting above this high here, above here. Even though this has been rated, this is still a new level of buy-side liquidity because of the assumptions that's being made in my analysis relative to this chart here. Okay, so we may not get it. I may be wrong, and that's fine. But I'm standing on the side of the fence that would be bullish for dollar going into next week. Now, remember, I'm stating that if we fail to rally, and say we break down Thursday's low, we trade through that. To me, that's problematic for the bulls for the dollar index, at least for near term. It would either indicate that we're going to stay in the range between the high and the low here for a more prolonged period, or we're going to go lower. So until then, I'm bullish dollar. So let's go back to this. I'm going to show you something. Okay. Consolidation. How's it a consolidation, Michael? What makes it a consolidation? Well, we have a range high and a range low. And notice the reaction here. We went back to equilibrium, traded away from it. Okay, so whenever you see a distinct price range that has a return back to an equilibrium, as we have here, this makes this a balanced price range. So the balanced price range also is many times the original portion of a market maker buy or sell model. In this case, the market broke away, traded back up into it, sold off. Distribution, redistribution, smart money reversal, low risk buy. We're looking for a move potentially above here for a market maker buy model. So if we know that these are likely to unfold, then our focus is going to be primarily looking for short foreign currency, long dollar. Taking us over to euro dollar. We had a small little inefficiency in here. Didn't quite get filled. We did trade up into an area we'll look at a lower time frame. We were expecting to see a reaction at anyway. but price is now trading softer. A lot of wicks in here. So again, this is probably going to be a high resistance liquidity run going lower. If we can get below this swing low right here, I think things will pick up with momentum on the downside, meaning that we'll probably see large ranges with down closes after we get this low here taken out. Until then, it's going to be a slow crawl. There's a lot of price action to trade through. Now, it doesn't mean that it can't just slam right through that. It would be great if it did that, because that would be very productive for my bullish dollar stance. Let's go down to a lower time frame. Here's that same chart we were looking at last week. I mentioned the distinction between an inefficient move and an efficient move. Okay, so this is much more efficient, meaning there's a lot of back and forth price action delivery. And price is going to have a hard time getting up here. But if it did, we would be looking for that breaker here. We got it, and we had one more time, hit it here on Friday, and then sold off. We drop down into an hourly chart. We have these equal lows here, and I believe I sent a tweet about this. I had a little hello sitting there. Below that, we have these relative equal lows here. So we have 2 points of liquidity that are going to be of interest to us this week. So this could be a downside objective for a short. And then we have these relative equal lows. Obviously, it looks like it's not equal because we have this and this lower. But again, we're focusing on liquidity pools. There's an absence of any real inefficiencies going lower because it's all pretty much efficiently delivered on the upside since February 15th. Looking at cable, we had our buy side liquidity pool ran out here. We've been looking for months. Finally came to fruition last week on Wednesday. Thursday we gave up the ghost. Friday we traded back down. This close above the bodies of these candles in this swing high here are a little concerning for me. I don't want to see it rally from here. I'd like to see it just reject and trade aggressively lower. I like this series of 2 down close candles on the daily for cable because we have a small little gap in here as well. So I like this as a downside objective on a swing basis if we can continuously move lower. So that's something to look at, and it's also a sell side liquidity pool or sell side liquidity. So we could see something trade down there if we really roll through. Now, if we start to consolidate in here, we'll probably want to make a higher run on cable. Just be careful with this one. I would counsel you to just study this one in here. Don't try to trade it because it can bite you and hurt you. So that leaves us with what? A very difficult short on Eurodollar. A mixed bag on cable. So this is the reason why I rung in the dollar CAD this week. Dollar CAD on a daily chart, we have all of the inefficiencies noted here. If you go down to lower time frames, I'll leave this for a study for you, but we'll talk more about it in the teachings for the price action drills for institutional order flow. We'll actually be using this currency pair for that study. But I have these levels here already in the chart, so if we get what I'm expecting to unfold over the coming weeks, these levels will be more significant and salient at that time. So we had a huge rally on dollar CAD last week on Friday, trading off of a bullish order block in here. Yes, it's hindsight. Yes, it already happened. But it's helpful to us because now we can go into price action in here and justify anything going further on the upside. Let's go down to an hourly chart. We had several highs rated in here, and I like this high right here. So if we can keep above that level here and trade back down into the order block here, So we have a breaker, bullish order block. Price can come back down in here and hit that. Now, it can still drop only to this price point here, fill this void, and find some support at 32.50 or 32.52 in that area, and then look for continuation on the upside. So we'll be watching those levels this week, and that's about all I have on the radar for now. I do want to talk about the time of day briefly. I add these levels on Ava Trade. Okay, and these levels are important later in the into the mentorship, because I teach you more concepts around true day. I teach you the standard deviations for flout, central bank dealers range, and the Asian range, and also teach you more elements about precision using those. But those times relative to Ava Trade's demo, keep them on your charts. That will frame the daily range in the scope that I will teach you institutional order flow with. Okay, so that's what those times are. Just know that you'll be taught more about them later in the lessons. I got a couple emails pertaining to these times and what the significance are about them. And again, you learn that later in lessons. Okay, looking ahead. This month of March 2019, since we had the government shutdown, it caused a delay and a halt, actually, of the COT data being released, the Commitment of Traders Report data. That will be normalized this month. As a result, next Friday, March 8th, will be the ICT quarterly analysis. It will post as part of the weekly review. So you'll have a very long weekly review. Technically speaking, the teachings ahead for this month, teaching segment for March 11th will be on institutional order flow entry drills, how to practice your entries using my concept of institutional order flow. March 13th will be the teaching on the ICT clutch pattern. March 20th will be trading big figures, how you can find bread and butter setups using the big figure levels, completely void of bias. And March 27th will be teaching framing New York setups. For charter members, you'll note that price action model number 2 for the 2019 class of the charter membership, they have access to that now. So if you haven't noticed that, go to the charter members area on the forum. You'll notice that it's active right now. And charter members model number 2, amplified teaching, will be on March 12th. So there'll be an additional module added to price action model number 2, again on March 12th. So the first charter member group from the 2016-2017 class, you will have an additional segment as well. And charter member 2019 class, you guys will have, and gals, will have that same amplified lesson added on March 12th as well. Until I talk to you next time, I wish you good luck and good trading.